Thanks for welcoming us here today. We figured that two were better than one, so you get the benefit of having us both here. I'm Allison Johnson. I am a corporate partner with Wilson Sonsini, and I operate in that first circle that Matt was talking about. I mostly work with emerging companies and the investors that are investing in those emerging companies. What does that mean? I work from the guy that comes to us with an idea and wants to form a company, all the way up through kind of IPO. I'm not an IPO attorney, and I pass it off to my trusted colleagues at that point in time. I first joined the firm back in 2007. I was with the firm in Palo Alto for about 3 years, and then I decided to return home to my roots. I'm from Boise, Idaho. So I left and came back to the Mountain West and kind of doubled down on the Salt Lake market at that point, Salt Lake and Boise markets, which were both growing quickly. And then just in December, Wilson decided to double down on its Salt Lake efforts and reached back out and gave me the opportunity to rejoin the firm and be part of the Salt Lake office. And it's been absolutely thrilling, and we're excited to be here. So that's a little bit about me. Do you want to introduce yourself?
Sure. So I'm Gina Kim. I am based in the Seattle office, and I've been with the firm about 18 years. And my practice also focuses on early stage companies, but for those of us who have been at Wilson Sonsini in corporate practice, a lot of times we will grow with the companies. And so I have startups that I started with 18 years ago who have gone on to do multiple rounds of financing, have acquired companies along the way, have flirted with the public markets, flirted with being sold. Some of them actually go out, some of them are sold. And this one I'm referring to in particular, tried to do de-SPAC recently too. So like in 18 years, we've kind of seen every flavor and color of corporate transactions. And so I tend to do sort of the full life cycle of private company work and early public company work as well.
That's great. And I wonder if I'm going to have to go all the way through your slides now. Sorry. Where do I point this to?
And while Allison's bringing that up, I'll say that during the years, Matt referred to this, when we didn't have an office here, we were still very much involved with a lot of the companies and investors who are in this area. And so I've, probably for the last 5 or 6 years, have been working very closely with a number of companies, and I work very closely with one of the large investors in town too, Invention and Capital Partners, and so been involved in this community, and we're just really thrilled to now have an office here and to continue to increase our investment and commitment to the community.
Yeah, our world's a funny world. When I first met Gina, Sorensen was investing in one of our clients, and so we were at different firms at that time, but it's a small world, and we find that there's a lot of overlap there. So we wanted to start by giving you guys kind of an overview of financing trends that we've seen. This presentation was began to put this together about 3 months ago, and we wanted to say it's already becoming outdated data. What we're seeing is there have been some changes, and we want to bring that information to you guys to give you the latest and greatest. But the last 2 years have just been huge growth years. You'll see on this slide, the first bullet is that there was 100% of Series B or later stage financings in Q4 were up rounds. That's unheard of in my experience. I've never seen anything like that, which means that each company that was raising money that we tracked raised at a higher valuation for their Series B than they did for their Series A. That's obviously the goal of every company when you go out and do a venture financing, but oftentimes there's hiccups along the way. There's regulatory hurdles, there's litigation, there's other things that impact company valuations, macroeconomic factors like stock market or supply chain issues. And we're seeing some of those things pop up now. So we were just discussing earlier today about these are the trends, and the trends were headed up universally. And now we're starting to see some pullback from the markets. And a lot of that is dictated by the capital markets and just the uncertainty in the macroeconomic conditions in the world. And the private investors will look to those markets when pricing deals or asking for what terms they want in those deals. And certainty gives everybody comfort in the terms of their deal, and more uncertainty in the markets makes investors a little bit more nervous. We're seeing them ask for greater control rights in companies, voting rights to approve deals that would be perhaps a down round. And we are starting to see a couple of down rounds trickle in. What a down round is a round that's done at a lower valuation than your prior round of financing. I don't know if you have any, we intend to share some more stories along the way to make this a little more interesting for you. Do you have any more data points there?
Yeah, I'll tell you about one down round. So I work with this is Initial Health, and in 2020 they did a raise, and it was at a nice valuation, several hundred million, and they were looking to do another raise, and they weren't getting quite the valuations. They had really high aspirations. If you kind of remember back in 2020, as everything was starting to shut down and people just didn't have as much, in-person access. It was a field that was really accelerating, and as they are looking to do a round now, at first it was kind of like maybe not quite as high a valuation as they wanted, so they waited and hoped that things would rebound. They're now at about half of the valuation, and part of that's based on public company comps for similar companies. And as the stock market has continued to be volatile and decrease in this area, their valuation continues to drop, and so they're just trying to get a deal done as quickly as possible. So there are definitely, some signs in certain sectors where they're really struggling to get the valuations they did a couple years ago.
Yeah, and it's not all bad news, especially for you guys, because early stage investors aren't as influenced by the capital markets and the stock markets. They will still be investing in, and we haven't seen lower valuations coming in yet in those financings. And so I think you still have good opportunities in the really early stage space. This slide shows you the median pre-money valuation in Q4 for 2021. Did my mic turn off? Can you guys hear me? Is this one on? Yeah. Oh, that's much better. I'm sure you missed all of that. So this slide I think is a really good demonstration of what type of money is being raised at seed, Series A, Series B, and Series C. We're going to go into what a preferred stock round is in our second session, but generally speaking, seed money is that money that just helps you get off the ground. And there's a couple mechanisms to take that money, which we'll cover in our second presentation. But I think the most interesting thing here is to see that the later stage financings are being done at such a higher valuation and taking on so much more money. But this gives you kind of a snapshot of what we've seen. The markets are still robust. Investors are still investing, especially in early stage companies. So it isn't all doom and gloom.
Yeah, and I would say that the really good companies that have sound practices and growth, they're still getting great valuations and still having competing term sheets coming in. So again, that's still the vast majority of the market, but I think it's just a little bit of correction on some of those later stage companies that got some really good, I'd say maybe overly high valuations when the good times are rolling.
Yeah. And this gives you a full year 2021 medium amounts reached. The Q4 2021 medium amounts raised saw increases from the prior quarter as well. You'll have access to all of this information, and if you'd like it, WCR puts out an entrepreneurs report with all of these facts each quarter. And so you can get on that mailing list. You can contact us and we can get you on that mailing list to get the most up-to-date data so you can kind of have a feel for how the markets are reacting. I went back. Oh, here we go. Here we are. So the first thing we want to cover is how do you form an entity and what type of entity do you form? First question is, or why do you form an entity? The answers to that is you don't want to put your house, your 401k, all of your assets on the line. So it's really important that when you start a business from stage one, that you actually form that entity. There are different entities, and what that does is it protects your personal assets. So unless you commit fraud, which none of you will do. So you want to make sure you form that entity right off the bat. The next question is what type of entity should we form? There are three basic entities that we see startups forming. The most popular is a C-Corp. We'll go through the reasons for that. The other two are limited liability companies and S-corporations, and they have pass-through tax treatment. And so a lot of companies that are smaller companies not looking to take on outside investors may consider those two as possibilities. So limited liability company is oftentimes referred to as an LLC. It's a partnership, and it has no entity level taxes. So that means you pass through your losses and your profits to your members each year. You issue them a K-1, so they all have to go file partnership tax returns. And the ownership interests of the members are defined in one single agreement, which is called the operating agreement. So you have one agreement, which some people like to have, and some people like to take advantage of those pass-through losses, especially for an early stage investor. It is not a common type of entity for VCs. Some of the reasons for that are VCs are looking for better tax treatment. They can get tax treatment for qualified small business stock in a C-Corp. And that allows them to sell some of their stock under the current tax regs at a tax-free basis. And they'll be looking for that. They also understand Delaware corporate law. And VCs, even the very established VCs, want to do what they know. And so a lot of times they won't invest in LLCs and will ask that a company convert to a C-Corp. Good news is, we'll cover this later too, that's an easy process to do. But if you know from the beginning, hey, I'm going to be starting a company, I'm going to be going out and doing a safe round or looking for institutional investors or traditional venture capitalists, I would start with a C-Corp right off the bat. If you are a company that it's just going to be you and your brother and your dad, and that's as far as you want to go, and just have an easy stream of revenue or not take on those outside investors, then an LLC can be a really great entity type for those pass-through tax losses. Any other thoughts on that? Same. An S-Corp is a corporation that acts more like an LLC for tax purposes. So if you want to be an S-Corp, you want to have a corporate structure and get the tax treatment, kind of like the partnership laws, then you would form an S-Corp. They have some really interesting requirements that sometimes people trip up on. They'll form an S-Corp. You have to file an S election with the IRS to say you want this tax treatment. But then you have to follow the rules, because if you don't follow the rules, you blow your S-Corp status. So some of the rules are, you can't have more than 100 shareholders. They all have to be individuals, so you can't have a venture capital fund come in and invest in you. You cannot have foreign shareholders, and you can have only one class of stock. Classes of stock are, you've probably heard the terms common stock and preferred stock. Common stock is typically what founders and very early on investors and employees will hold. Preferred stock is typically what investors will come in and want to get. It has different rights and preferences and privileges attached to it. For instance, it will dictate that the preferred stock will vote on certain matters, and you can't do certain things without getting the vote of the preferred stock. Sometimes it will have a board seat attached to it. A lot of times it has economic rights attached to it. So we'll cover this in our term sheet discussion later. But for those types of reasons that you can't have those different classes of stock, oftentimes an S-Corp is really not a viable option for VCs. So again, if you're just more kind of a friends and family company, you're not looking to expand, an S-Corp can be a great vehicle to take advantage of the pass-through losses and tax treatment. But if you're looking to scale a company, if you're looking to offer equity to employees, if you're looking to bring on VCs, it's really not a type of entity that we would suggest you use. So then we get to the VC favorite entity, and the one that we deal with probably 95% of the time in our practice. A C-Corp is a corporation. You can form it in any state. Oftentimes people form it in their home state when they're headquartered. Most frequently, it is formed in Delaware because, again, that is just what VCs know and have come to expect. Its corporate governance is set up so you have stockholders who elect a board of directors. We're going to talk a little later on about how do you decide who's on your board of directors, what are you looking for, when do you need a board of directors. But the board basically appoints the officers, oversees the strategic direction of the company, and they can be good and bad. They can ask really hard questions. And as a founder, if you don't control the board, you can be terminated as an executive. And a lot of founders don't realize that until they're too far down the road. So you want to make sure that you get a board that's strategically aligned with how you want to operate the company. C-Corps also have officers. They're tasked with managing the day-to-day operations of the company. There's no pass-through tax benefits. So the shareholders don't get the profits and the losses of the company passed through them each year. It's taxed as a separate legal entity. The reason VCs like it is they can invest in it easily. They can invest in it at all. Remember, at S-Corps, entities can't invest, only individuals. So it's investable, it's understandable, and it's really easy to offer equity incentive to employees, advisors, and other service providers, which when you're a startup, that's really key to bringing on that key talent, because oftentimes you don't have a big bank account to take on a large payroll. What people are really looking for is to have a small piece of the company so that they can benefit from the gains in the growth of the company. And a C-Corp really lets you do that easily through the administration of a stock option plan. So what happens if you form an LLC and then you want to take on a VC, or you want to issue 2 classes of stock and you're an S-Corp? Well, it's really easy to actually convert from an LLC to a C-Corp. I say it's easy, but it does cost money. So, and time. And as states get backed up in filing, sometimes we've seen these conversions take up to a month to get completed. And when you have a VC who's ready to write a check to you, that can be really frustrating for companies. So again, I go back to that original statement. As you start thinking about forming a company and picking a type of entity, it's really smart to think about what's 6 months down the road, what's 12 months down the road. Am I going to be expecting to take on outside investment? Is that a key of my objectives? And I think most of you, if you're looking to invest in or form a company in biotech or technology space, most of you will probably be better served by being a C-Corp from the outset. Where to incorporate? I touched on this a little bit earlier. Sometimes there are reasons to incorporate in your home headquarters state. Sometimes states will offer grants to companies that are only headquartered in their home state. Sometimes you will only have employees in your state and only be operating under Utah and not have any customers outside of Utah or any other state. Those can be some reasons that you'd want to form in Utah. Outside of those reasons, again, I would suggest forming in Delaware, because oftentimes when you get that first big round of financing, you are going to be asked to convert into a Delaware C Corp anyway. And so you can avoid incurring those cost expenses and time delays if you form there. But again, think about what are the reasons to form in Utah, and could you avail yourself to some of those government grants or other things offered by the government and entities that are looking for Utah-formed companies. You also want to think about your IPO objectives and reincorporation. So if you are a company that has goals to IPO, almost universally they're Delaware C Corps. All right, so when you go to do your startup, there's 4 kind of buckets of documents that we would help you draft, or that your counsel would help you draft. We flat fee this kind of work. I mentioned that because this seems like a lot to a lot of people. But we know little baby startups don't have a lot of funds, and we're happy to flat fee this work and use that Neuron platform that Matt was highlighting to do it. We can help you incorporate in a matter of days once you're ready to pull the trigger. Yeah, go ahead.
Is it ever too early to form a company?
That's a good question. I do have people with entrepreneurial spirits. Sometimes they go out and form companies. Well, I have a thought that I'm going to do this, so I'm going to form a company here, call a company here, and they get tied to kind of a brand or a name and they form a company, that's the only time that I think it's too early. Otherwise, I would form a company. If you have a business plan, if you're pursuing something, the minute you devote resources to an enterprise, I would form a company. It's relatively cheap, and you draw that line from personal liability. A lot of times we'll see founders, they'll come to us, and they haven't formed a company yet, but they've kind of been out doing trials on their own or getting market data or letting people use their product, even if it's just a prototype, on their own to get that minimum viable product and figure out, what might be the right avenue to pursue. But that like sends alarm bells off in my head, because if you have a product or a service and somebody uses it and you're not under the umbrella of an incorporation, you really are opening up yourself, your family, and all of your personal assets to liability. So I guess my answer is no. And that it's never too early to do the actual formation. And you can form a company and issue founder stock at a later date. So even if you're still in discussions with your founders about your co-founders about how you're going to split up equity and those types of things, you don't have to have that all figured out on day one. It's good if you do, but you have time to be able to do that at a later date. So I don't know if there's more context or any follow-up question.
And what about working with universities and SBIR companies and SPR companies and things like that? What are some of the things you've seen that sort of good and bad about the government grant program forcing people to create companies early?
I don't know that I have any direct story. Do you have anything? I think you put it, by forming the company as early as possible, it forces the discussion of what assets are going into the company. And it'll cause each party to figure out, is this a joint venture? Are we going to do a revenue split on these assets? If universities own some of the IP and an entrepreneur is going to go off and take it, that it forces that conversation, and I think that's an important one to have. So incorporation documents, that's the actual what forms the company. Founder documents as a category are what documents does each equity owner who is working for the enterprise at its initial formation, what do they sign? Employee documents, or documents, we can also say consultant documents there, documents that you'll use to bring on your service providers. And then there's basic third-party agreements. As an early stage company, you go out to larger parties and ask them to try your products or services or do a beta test or any of those types of things. They're going to oftentimes put you on their paper, meaning they're going to have their form of agreement and ask you to sign up to it. But you do want to have NDAs and other basic documents in place that you can serve up to people and that you should serve up to people, because you've spent all this time creating a company and you don't want to release proprietary information into the wrong hands. Incorporation documents, certificate of incorporation, that lays out how much stock is there, what are the rights for each class of stock, bylaws, general governance, who is your board of directors, what officers do you have, how can they be appointed and removed, and then there's organizational minutes and resolutions. That's how you name your board members, you do appoint your officers, you approve the issuance of stock and other administrative matters. This is all pretty cookie cutter, plain vanilla stuff, but those are the basic documents that when you say I have a company, these are the documents you would present. And a bank would want to see it when you go open up your first bank account.
And it's pretty, it's pretty cookie cutter, but you want to get it right from the very beginning, because if you mess up some of the things from the very start, like you don't properly appoint your board of directors, for example, and it's just papering it, then all the things that you do years later could potentially be invalidated. So you have to go all the way back to the very beginning and correct it all. And it kind of goes to what Allison was saying earlier, just if you know from the beginning that you want a fundable sort of company that's going to scale, getting it right in the beginning is going to save you a lot of time and expense later.
Yeah, for sure, and that's a perfect segue into where we see the biggest issues. Founder documents are the ones who really do want to spend the time to get it right. The first one is an invention assignment agreement. This is an agreement that everybody who touches anything on your company should sign. It basically says that when they do work for the company, that work belongs to the company. It assigns the work that they do, any IP rights, and any registered IP, and any soft IP will be assigned to the company. It also has confidentiality clauses, so if an employee comes and gets your Rolodex of contacts and your business plan and all of the things that are proprietary to your company, they can't then go walk and use it and disclose it to other people. And then there's the question of the non-compete, which is always a question for companies and founders. A non-compete operates to restrict people from working from competitors for some period of time after they leave the company. I say it's always an interesting question because we counsel as company counsel. Our client is the company, not the executives necessarily. That each founder should also sign an invention assignment agreement with that non-compete because it protects the value of the company. Investors will like to see it and will assign value to knowing that the person who started the company, who is the secret sauce of the company, can't go compete for a competitor. But as a founder, as an executive, you also have to evaluate what that term of the non-compete is and how it impacts you individually. Net, my recommendation is that you have a reasonable non-compete in place to protect, again, what you're working so hard to build. I don't know if you have any other.
Yeah, the only thing to add to that is non-compete is a state-by-state law issue, and in some states like California, you can't force non-competes. Washington, where I am, if you're a certain salary level, below that, you can't force a non-compete on your employees. So it is a state-by-state issue. I'm not sure if you want to talk about Utah in particular since we're here.
Yeah, and that's a great point. That it's a state-by-state issue, and we do see these things come up in legislature often about whether non-compete should be prohibited, about the term of enforceability of a non-compete. You will see in most non-competes, they're drafted to be what's called blue pencil non-competes that says, here's your non-compete. It's reasonable within the state law in which you live in today. But if there is ever legislation or court cases that carve back that non-compete, this non-compete will be automatically carved back to those reasonable terms instead of just setting it aside. But some states will just completely disregard it if you don't operate within the state-by-state requirements for what makes a non-compete enforceable or not enforceable. It's also really good to monitor your employees, especially over the past 2 years when there was so much movement of employees in the kind of work remote environment. Those employees that maybe used to be in California and couldn't be subject to a non-compete have now moved to Utah or Colorado or Idaho or somewhere else. And so it's good to do an annual census to figure out where your people are. It's good to have your people report to you where they are, both for non-compete purposes and for other tax and state filing requirements. So it's really good to keep a handle on where your folks are at.
Yeah, and you hit on a good point. The non-compete is based on where the employee is, not where the company is based or where you're incorporated. So you could be a Delaware corporation based here in Utah, but have employees in California, Texas, Utah, everywhere. And so you may have different non-competes based on where your employees are. I have one company who just said, because certain states are starting to do, not enforce non-competes, just as a recruiting matter, they said, okay, for the rank and file, we're not going to have non-competes. For executives, we still will. Or sort of, engineer managers, people that they're really concerned about, potentially starting a new company elsewhere. And that's just kind of a recruiting tool they use. So it's definitely something to consider.
Yeah, we talk about non-competes
Yes.
frequently. What we call restrictive covenants. These can be non-solicits, meaning you can't go solicit employees to go work for your next company, or you can't solicit customers who you are actively working on at the company. So there's a whole bucket and basket of things that you can think about in terms of protecting the company's value.
We have a question, Allison.
Oh, sorry, I didn't see you.
Yes, sir. I have a more sort of strategic question about founders. So for technology-based companies, especially when it's started at the university, so the technology side, who founders are is clear. But I've seen two models where people will try to get sort of a business or a lawyer type co-founder to perhaps do some of the things that you guys do sort of internally, and others are saying, well, we don't need this, we're just going to hire an external law firm to do this kind of work. So what is your experience and what is your advice?
Yeah, great question. I'll repeat it to make sure everybody could hear. Tell me if I get the repetition wrong. The question is, specifically at a university context or otherwise, you've got the people who start the business, who've worked on the technology or the product, and they go out and they start the business. Should they be seeking a co-founder to supplement their skill set? Should they be seeking a co-founder who is more straight business oriented or legal oriented or has some different acumen that they bring to the table? Do I have that right?
Right on.
So, my take on this is, you know the right co-founder when you need them. If there's somebody, if you think you, I wouldn't hire a lawyer as your co-founder because I don't think we probably bring enough to the table immediately to really prove value. If you have enough holes in what you think will prevent you from being able to grow the company on the business side, if you need major help on the finance side, if you need major help on sales and marketing, I would take a look at your business plan, which we're going to talk a little bit later about how do you put a business plan together when you're just starting out and have that vision for what you need in the future. I think that those are times when you look to find people to stack on. What most of my clients do and what I advise is not call somebody a co-founder unless they really are a co-founder. People talk about founder stock and co-founder status. It doesn't really mean anything. There's no legal, legal terminology that gives you special rights if you have founder stock. But there are certain things that a co-founder expects and will put themselves out as a co-founder of the company. If somebody is a high-level executive who's bringing really strong business acumen to the company, I would hire them on as an executive in that specific role. Chief sales officer, CFO, chief legal counsel, whatever the place that they're going to serve is. But if you are where you think you have a product or a service and you are hitting the ground running, and you've been operating for some period of time, I wouldn't go out and search for a co-founder. If you're at the very early stages, I think it can be really helpful to have a partner to bounce ideas off of, to grow, to pivot, to iterate and come up with those minimum viable products. I think having somebody else with you is helpful to keep the trains moving and keep you motivated, but it's not necessary. Do you have any? I know Y Combinator requires 2 people generally to come in as co-founders. Y Combinator's one of the largest startup, I guess I would call it an incubator, that you apply for. And they require co-founders to come in. And I think it's just for that purpose, to have a team. But in my mind, there's really no requirement that you do it. But if it's something that will serve you well, do it. But protect your equity. That's why I would call it an executive, a senior level executive, and not a co-founder, because co-founders expect large equity pieces, and I'd be very careful to protect your equity.
Yeah. And you can outsource initially a lot of, accounting, tax, legal, HR, some of those things that until you really grow and scale, you don't necessarily need to hire a full-time, FTE for those roles.
Yeah, and that's a great point. I would hire a lower title if you can get the talent at a lower title and offer some equity incentive and see how they do, right? If somebody really comes and brings it and it's very clear that they are acting as a co-founder, then have those conversations and promote that person and treat them well because they're serving you and the company well. Yeah, any other questions at this point? Okay, awesome. Founder's stock oftentimes has vesting provisions associated with it, and a lot of times investors are going to want to see vesting associated with the stock that's issued to founders. So what is vesting? Vesting is a time period. It can be based on time or it can be based on milestones, but what it means is you don't own that stock until you meet those vesting criteria. So most often we see founder stock be on a 4-year vesting term with a 1-year cliff. What is that? Or early stage, not even founders, early stage executives are on that same kind of vesting schedule. So that means that they're with the company for 1 year before they own that stock outright. And then it vests monthly over the next 3 years, meaning that they get 1/36 of the remainder of the stock over the next several years. Why do you want to do that? It really, really is hard when somebody brings somebody on and just grants stock outright with nothing tied to it. Because sometimes it doesn't work out. The person you hired that you thought was going to be amazing is not so amazing. Sometimes they are fired. And then you're faced with, if you don't have vesting tied to the stock, then you're faced with this situation where somebody's walking with massive ownership in the company and hasn't done anything to contribute to the company. So making sure that you get that vesting schedule tied to anybody that you grant stock to or stock options to is really important. It can have acceleration terms. Acceleration means if certain events occur over the course of the vesting, then it will accelerate the vesting. So if you sell the company and somebody's only been with the company for a year, so they're only 1 quarter vested in their stock, you can give them the benefit of that and say, we're going to vest you 100%. You're going to own all of that stock at the time of sale.
Yeah, one thing that with the vesting for founders that I get asked a lot, and this goes to the question earlier, what if I've been working in this company for 6 months, but I didn't get around to forming it? A lot of times the founders will give themselves credit for that, like right up front, they're already, 6 months into the vesting. So there are situations like that are acceptable.
Yeah. And sometimes founders don't want to tie any vesting to their stock because they're like, I started this company, or I'm the only shareholder, why would I tie vesting to my stock? And you can do that too. You can expect that an investor will come in and ask you to start a vesting schedule. So just be prepared for that. Yes?
Can we please go back to single trigger versus double trigger?
Yes. Happy to talk about that. So on that acceleration, single trigger versus double trigger, this generally applies in the context of an acquisition, a sale of the company. So if you have, single trigger is if there's a sale of the company, my stock vests 100%. I get 100% on a change of control of the company. Double trigger is a little less favorable in that it says, if there's an exit of the company, and I'm terminated as a result of that exit, then I get 100% acceleration. What that means is a buyer would generally assume those options and you would continue to vest over time. And 83B we're going to cover later on too. So the general rule is that founder stock is taxed at fair market value on the date of grant. Or as it vests. It has to be, whenever you grant stock to somebody, you as a board have to determine what the fair market value of that stock is at the time of grant. Now, when you're a little baby startup and you don't have any revenue, that's really hard to do. There are outside valuation firms that help with this, and a 409A valuation, which we will get to later on. But the important thing is, if you're going to grant equity to people, do it earlier in the stage of development of the company and use that vesting to make sure you're not giving them too much equity versus waiting later to when it's at a much higher valuation. And I'm going to cover why, but it looks like there's a question.
Sorry, maybe we'll get to it.
Yeah.
So commonly companies are founded and shares granted under states. How does that have an implication for fair market value and exactly what you're driving?
Yeah, no, that's perfect. And we'll talk about the safes and convertible notes a little later on. But safes and convertible notes are great instruments for early stage investments because you don't have to decide what the company is worth today. Because inevitably, you as a founder will think the company is worth way more than the investor is going to think because you see the possibility, they see today's reality. And so safes and convertible notes push that valuation out to when you do a priced round. I think your question is, and let me repeat the question. It was, how do safes and convertible notes impact fair market value, or how should you be thinking about those in the context of determining what the fair market value is? When you go out and you get an outside independent appraisal by these 409A firms, they will look at what safes have been issued, what convertible notes have been issued. If there is something called a cap in those safes and notes, it's a data point that they'll put into their formula when determining what the fair market value of the company is. Oftentimes those caps are set at what you think the company will be worth in 12 to 24 months. So they can be data points, but really what they're looking at is, what is your revenue? What are your similar companies valued at? And it always kind of spits out a magic number, which tends to be a quarter of the value of preferred stock, roughly speaking. I'm not an appraiser, but that tends to be what I see. Does that answer the question, or do you have additional questions? Anything else from you, Gina? No? Yes?
There was like a point made in one of the training courses that your company is really worth nothing unless 409 valuation comes in, and this official documentation of what the company is worth. And then this was done in a relationship to exactly like you buy shares like 1,000 at a penny for nothing, then safe comes in, now the shares worth something, and then when you hire from the option pool, you hire new employees, then they're going to be hit by a tax on the shares that you're offering them. And the argument was that your company really was nothing, you can still offer them this 1,000% cost of shares unless there is 409 in place.
Mm-hmm.
And this was apparently treated as a gray area, so some companies treat it this way, as like its companies worth nothing unless 409 is in. The other treat it as, okay, if you have a safe in, then your stock now is worth the amount.
Yeah, so the question I think is, when you get your 409A and so what's the timeline? If you get a safe, is that the point in time and you need to go get that 409A valuation, and what's the difference between how you can value your stock before you do a safe or a convertible note financing versus after? Did I get the question right?
Yes.
So generally those early stage formations, when you're just starting out a company, there's really no assets in the company, which means you can grant stock at a really low price and have a reasonable position in doing so. Pennies. Pennies is oftentimes the value of the stock at that very first formation. As soon as you start producing revenue or you put assets into the company, if assets are transferred from the university or otherwise into the company, then those need to be taken into account for what that value is. And so those are events that the board would have to look at in determining whether the fair market value is kind of above that baseline nominal valuation. And then safes are the same way, and convertible notes. If you've done a financing, there is a almost 100% certainty that the company is worth something more than it was when you just formed it and it had no value. Generally speaking, I advise, Gina, I'm interested in your viewpoint here because it is somewhat of a gray area, but we advise that once you get that first financing in the door, you really need to go out and get that 409A valuation. what that valuation does, it gives you as a company the benefit if the IRS ever comes to audit you or an employee who has stock options, and they find that the stock was granted at way below what it was really worth, you're going to have excise taxes and penalties on that spread. The 409A gives you a reasonable presumption that you granted stock at a fair market value. So it's really kind of a safe harbor, and we suggest that as soon as you do a financing, you should definitely be getting out and doing a 409A.
Yeah, we have a lot of content, so you wanted to hit on the most important one, which is file the
Yeah.
APB. So yeah, I think the big takeaway from all of that is when you get your founder stock within 30 days, you have to file this 83D election with the IRS. There's no makeup, there's no fixing it later. And if you don't, as your company's stock continues to rise in value each time you invest, you're gonna have a taxable event. If you take care of it in the very beginning, you won't be taxed on it later as it vests. So get it right.
Yeah, and you'll have all of this content in the slide deck after you get it. Oh, go ahead.
Sorry to stop. Just to go back to this, it's too early to start a company. It's kind of like now we have a deadline 30 days, so kind of, I just wonder from the tax benefit point of view, are there some like a time limit? So this tax benefit only good for a company with 3 years of incorporation, something like that also need to be consideration when to start a company.
When to start. I mean, I think the question is, with this 30-day timeline and other factors, is there some time period that you should really be operating under to establish when to start a company? Is that right?
Yes.
Okay. So the 30-day deadline isn't tied to when you start the company. It's tied to when you grant the stock to people. But I go back to my original answer that I never think it's never too early to start a company, for the very reason that if you start it now, you can issue stock to people at a very low valuation. If you started at the very early stages of your idea, and you want to give people the benefit of that, because the consequence of having your stock grow in value, which you want to have happen, everybody wants their stock to grow in value, is that if you grant stock to employees at a higher valuation, and it's stock, not options, they have to recognize the value of that stock as income. And you're not going to fork over the cash for them to pay the taxes on it. And so the earlier that you can grant stock to your key team members and onboard those key team members and advisors, the better it is for them. And so I would really use vesting and forfeiture to guard against what happens if they don't contribute or they leave, or how do I protect myself. But try to give them the value of that earlier valuation. The biggest question, the most common question we get asked is, oh, I really meant to grant the stock and these options to these people, or I issued offer letters that said I would, and it would be at 1 cent a share, and I didn't do it. Can I do it now? And the answer is no. There's not really a workaround. And so people really struggle with that. And so getting your company up and running, getting your stock plan ready to go, and granting options is not a hard exercise to do. You just have to do it. You have to do it and take care of your people and fulfill your promised obligations when you make them, not down the road. And a lot of entrepreneurs got their heads down on the business and sometimes just don't get around to doing this, but it has real consequences for you and your key team members. So take care of it early, form the company early. That's the best advice I can offer you. Yes?
What's the typical percentage of options you offer with shares outstanding? 10%, 15%?
Yeah, so at formation, his question is what is the size of option pool that you make available to service providers? At the formation of a company, we generally advise to form a pool somewhere in the 10 to 20% range. How much of that you give out at the outset is really dependent upon how many key team members you're hiring And also what you're paying them in cash, right? If you have cash and you don't have to give away a lot of equity, then the equity grants will be smaller. But if people are taking a smaller paycheck on the expectation that they're getting equity in a company, which is one of the greatest tools you'll have to bring on talent, then your rewards will be a bit higher. And we're happy to always provide data points of rank and file employees, what kind of grants do you see for them, and key executives.
Yeah, my board doesn't get paid, they give them options. So I'm trying to figure out what a good value is for total option pool, the size of the option pool.
Yeah, I'd be happy to talk about that. And it's a good point. Board members can get options that can help you bring on really strategic advisors and other key partners into the company. Options, the process for granting options and restricted stock. You want to make sure that you have your stock plan in place. You want to make sure that you check the box on securities laws considerations. This also depends on where your employees are located. There's generally exemptions, meaning you can do it to any employee in any of the 50 states. In other countries, we get that question a lot. Hey, I hired a developer in Ukraine, I want to grant some options. That's more complicated. So always consult with your attorney to figure out, to check those boxes and make sure that you're not stepping over any hurdles that you shouldn't be.
Yeah, one of the pitfalls I see is, you'll have an offer letter, you want to hire someone, you're like, okay, I'm going to give you a bunch of options. You shouldn't be granting options until they actually start working. You can certainly in the offer letter say, hey, once you start, here's what we'll propose to give you, but those are just some of the technicalities, you just don't want those pitfalls.
Yeah, and I love these questions, guys, so keep asking them. We were hopeful that we would have a little interaction, so keep them coming. Generally, though, the best advice that we could give to you is do it right the first time and do it. Grant the options, get them papered properly, consult with your counsel, because cleaning up this mess is sometimes disastrous, sometimes a deal killer. If you have a potential buyer come in and they see that you have terrible corporate records, that you made promises to employees that you didn't keep, that you granted options below fair market value, they will get cold feet. And I have seen buyers back out of huge deals because they don't want to deal with it and bear that liability. So make sure that you do it cleanly from the start, and you'll be so much better off in the end. These next slides are a little bit about the tax treatment and difference between ISOs and NSOs. ISOs are incentive stock options. They are only available to grant to employees. You can't grant them to board members or advisors, but they do have some favorable tax treatment that you'll want to consider granting. So most of our clients grant ISOs to employees and grant non-qualified stock options to independent advisors and consultants. Whether an employee can actually avail themselves to that better tax treatment depends on when they exercise and for how long they hold the stock. I don't know that we need to necessarily get into the details of that for this, but I'd be happy to talk to anybody that has any questions about that.
Question.
Yeah?
You said on the ISOs for employees, they have to be full-time employees?
No, just W-2 employees. Any other questions at this point?
Can you talk a little bit more about the alternative minimum tax liability?
Yeah, so that relates to the holding period for your ISOs. So, and I'm not a tax attorney. There are some nuances to it, but if you granting an option to employees is not taxable on the date of grant, which is why most people with companies use options to incentivize employees, because they don't have to pay taxes on them when they're granted, and they get to sit on that while they're a service provider and decide when they want to exercise. To get the better tax treatment, to get cap gains treatment, you have to hold your option for 2 years, and you have to exercise it 1 year before a liquidity event. And that's why oftentimes they don't get, even though they have the ability to get better tax treatment as incentive stock options, oftentimes it doesn't really happen because most employees will hold on to their options until there is an exit event and they know that they have built-in value, because they don't want to pony up that exercise price until until they know there's actual value, because you're taking a risk there and having to come out of pocket for the tax, or the exercise price. We covered this already, but in our conversation, the exercise price has to be 100% of the fair market value on the date of grant. ISOs are only to employees. They can have a maximum term of 10 years, and they can be exercised for a period of 3 months after somebody terminates with the company. So when you have incentive stock options and an employee leaves the company, they can deliver an exercise notice, exercising their vested portion of that stock for that 3-month period. And if they don't, it returns to the pool, and you can use that amount to grant to other people. If you wanted to have a longer period to allow somebody to make that decision to exercise their options, you could amend an option, but it automatically converts to an NSO. NSOs, there's no tax at grant, just like an ISO, which is good. But at exercise, there is ordinary income on the spread of the option.
We only have a few minutes left, so.
Yeah, so let's get to a little bit more of the, wanted to talk to you guys a little bit about non-diluted financings, because it's a type of financing that is not often available to traditional companies, but what a non-dilutive financing means is a way to get money without having to give away equity. And in the biotech space, there are tax credits, programs, vouchers, grants, and other tools available to you that you may want to utilize. So I would do your research to figure out if there's any of these kind of financing options available to you that you can take on without having to give away equity in the company. The best example of this is the PPP loans you guys may have heard about when we were in the COVID era. So the government authorized PPP loans as long as those loans were used for payroll purposes. They were oftentimes forgiven 100%. Nobody had to give away equity. It was a government grant, essentially, to fund companies. So that's an interesting thing to think about. There's also revenue-based financing. Revenue-based financing is a flavor of a note or a loan. And what that means is somebody will loan you money and they will expect a certain return on that money. So if you're producing revenue, you would pay a certain portion of your revenue out, plus a small premium to the lender, but you don't have to give away equity. So it's a good possible thing to pursue. The other thing, the last thing I think we wanted to talk about before we open up for a few questions is the role of the board. As new founders and entrepreneurs, a lot of times what a board is, who should be on that board, is really just unknown. The role of the board is generally overseeing the company's management and business strategies to create long-term value. Each board member, including founders who are board members, have fiduciary duties. Duty of loyalty, duty of good faith. That means you can't self-deal to yourself. You have to be looking out for the best interests of the company and its shareholders, and not you as an individual. The board supervises managers. It oversees the business affairs of the company, and it oversees executives. So what I touched on earlier, executives serve at the discretion of the board. So you want to make sure that you pick board members who are strategically aligned with you. Investors will often ask for a board seat. Have that discussion with your counsel about when to give board seats and how to structure your board and what matters to you. And think about having independent people on your board, strategic advisors who can really bring value to the company, who aren't just financial investors, but who can bring contacts and things that will help grow the company. If somebody asks for a board seat and you don't want to give away a board seat and want to give away a vote, you can give them what's called a board observer seat. That basically means they can come attend board meetings, they get all the board materials, they can comment in board meetings, but they don't have a vote. So it's a way of kind of meeting them in the middle, of giving them access to company materials, but not giving away that control. And then I think when looking for that board member, really make sure it's the right cultural fit. before you ask somebody to come on. It's the same for the investors. When you bring an investor on, make sure that it's the right fit for the company. You share a strategic vision, you're aligned, because you're going to be working really closely with them, and they should be adding value to the company at each stage. I think we've met our time. Are there any last questions?
Touch on advisory board.
Yeah, so advisory boards are a great tool to use. Advisors are, generally when people talk about advisory board, they're talking about those strategic points who can help propel the company. You want to enter into, and they're used also to, if you're putting a slide deck together for venture funding and you have this really strong advisory board, and I think it shows really well that you're well connected, really experienced people are interested in the company and helping you along the way. So it can be a great tool. Generally, when you have an advisor come on, you enter into an advisory agreement. That establishes a service provider role that then will establish your ability to grant options to them because they need to be a service provider. And like with employees or consultants, I would strongly advise that you have vesting associated with it. If they are an advisor and you think they're going to do things for the company and they've promised to do things for the company, I would put it in an agreement and tie any equity grants to what they're doing. Whether that is be available 5 hours a month for consultancy, or whether that is help increase sales, or generally attend board meetings, or review my slide deck, or provide some specific skill or service to the company, you're going to want to specify that in the agreement itself.